Welcome back to Value After Hours. I'm your host, Jake Taylor, and I'm joined by my usual suspects, Bill Brewster and Toby Carlisle. What are you guys going to be talking about today for your segments? Go ahead, Toby, you first.
I'm talking about HEI. They've returned 47,500% since father and two sons took it over in 1990. They did 1,270% over the last decade too, which is 5x the S&P, 5 times Berkshire. Pretty good effort.
Mr. Brewster?
I'm going to talk about revisiting a previous answer that I had and a potential error of commission that I made. I wish it was more exciting as Toby's. That's quite an intro, Toby.
And I'm going to be covering a little bit of nuance between this idea of the stretched rubber band between value and glamour. And then we also have a couple good mailbag questions. So we'll be back right after this.
Tobias Carlisle is the founder and principal of Acquires Funds. For regulatory reasons, he will not discuss any of the Acquires Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquires Funds or affiliates. For more information, visit acquiresfunds.com.
Should we kick off the topics?
Sure.
Do it.
Should I take it away with HEICO? Great article. So I was sort of talking about a little bit last week that it's the father, Larry, who's 81, and he was an Arthur Andersen accountant, and then the two sons, Eric and Victor, who are in their 54, 51. So they approached Dad in 1990 to say, let's do an LBO, because that was sort of still the LBO, just after the LBO craze had kind of peaked with the barbarians at the gate. So they find HEICO, which basically had one product. It was an engine combustion chamber, whatever that is, made by Pratt & Whitney, and they'd spun it out. So they got control of it for $3 million. That was half equity, half debt in 1990. Since then, they're up 47,500%. And over the last decade, they've done 1,270%, which is 5x the S&P. And more than 5x Berkshire, just for kind of context, because they've both done around 250%, which is still not bad over that period of time. So now revs 2.1 billion, profit 328 million. They've acquired 78 companies. Basically what they do is they try to buy something that's got very fat margins and some sort of competitive advantage, and then they just reduce the margins to price them properly. So they sell 100,000 parts. Their target, which I found was kind of interesting, they look for $10 million in profit, margins over 20%, and then they try to buy 80% because they want existing management to remain incentivized. And they've done about 9 acquisitions in the last year, which is sort of a little bit more than they have in the past, but they're basically the entire engine of growth of this thing is the ability of these guys to acquire companies that do continue to grow and make money over time. So they are really, really good investors, buying cheaply. And that's sort of the analysis. That's as simple as it gets.
Do you know what their typical multiple is that they pay on that 10 million-ish?
I don't.
On the for the acquisition?
Yeah.
Yeah, I think it's roughly 8 times EBITDA.
Okay.
Is what they target. Interestingly, in their 10K, they have, you know how Bezos has the cash flow statement up front? They have on, I think, pretty prominently on page 2, like disciplined acquisition strategy. And they're, some of these businesses, I do think that when you open up the 10K and you just read it, it's like, oh, these guys know what they're doing.
They're talking about it all the time.
That's right. And like they put it in a way that is easy to digest. And I read their fourth quarter earnings call, and I read the 10K, and I read Scuttle Blurb, his write-up on HEICO and TransDime. Shout out to Scuttle Blurb.
Is
People
that public?
Should subscribe. TransDime?
The Scuttle Blurb write-up on HEICO?
Oh, no, it's behind a paywall, but it's worth paying for if you're interested in this stuff. He's a solid resource. So anyway, it's just interesting. So there was TransDime, who sort of runs like a levered acquisition strategy and then hikes price, and maybe goes a little bit more aggressive. And then Scuttleblurb says something along the lines of like, I love Heiko, you love Heiko, we all love Heiko. It's a family-run company. They do things the right way. They're trying to save engine or the airline's cost, right? They're not about pushing price. They actually comment in one of their I don't know if it was the earnings call or what, but they say something like PE's got to raise price because they carry so much debt. Our net debt to EBITDA is under a turn. Like, we can play the long game. So I for the longest time had closed my eyes to the name because of the multiple, and turns out maybe that was dumb.
How do you value it?
I think you got to look at it on free cash flow and then sort of embed some acquisitions in there.
What sort of yield are you getting at this level? Do you know?
Well, your entry is only about so it's trading at roughly 35 times free cash flow, so 2.8, 2.9% out of the gate.
Oh, that used to be expensive.
It did used to be expensive.
Yeah, that used to be like a puckering number. Now it just seems like
that's half price now.
Right?
60 times is the market. 35 is like half price.
To be fair, something that I've been thinking about, and actually I've got a mailbag question on this a little bit, is what is an asset like this? What's your downside risk really in that multiple? Because an asset like this, in most realistic scenarios that you can underwrite as today's world exists, probably isn't going to trade at less than 20 times free cash flow.
I'll remind you of that sometime over the next 5 or 10 years.
We'll see.
Was that a bag holder quote right there?
It could be.
You don't think so? If your end user is airlines, and I know I own one, so they are cyclical. They're still cyclical. You don't think that you don't think that the suppliers are a little bit cyclical too?
Well, they're going to be a little bit, but even after 9/11 and in the Great Depression or the Great Recession, average seat miles are flown, or available seat miles, actually didn't decline that much. We'll see what goes on with all this flight shaming and whatnot, but
not much is my prediction. For what it's worth.
I think so too.
Nobody flies because they want to. You're basically flying because you got somewhere you have to be, and there's no other way to get there.
That's fair.
Flying's terrible.
Yeah,
but it's better than all the other forms of transportation.
Yeah, it's better than
right?
It's better than driving there.
That's right.
But only just.
Where was I going? I'm thinking of flight shaming and how much I'm about to travel over the next 3 months. I should be shamed.
Can't you just buy some carbon credits and offset it? Just tick the box.
No, that's somebody else's problem. Anyway, Heiko gets to do the replacement parts. So as long as there's planes flying in the sky, you're not going to be able to defer your maintenance. So I don't disagree that there will be peaks and troughs, but I don't know. I think maybe we'll see if it ever trades south of or higher than 5% free cash flow. I'll probably be a buyer.
Isn't that kind of the argument, though, for those? You almost want volatility in the industry because when you have a good acquirer, that becomes opportunity for them, right? So it's not you worry about them being disrupted, but maybe more so you want that for them to throw off opportunities for more acquisitions, for the weaker hands to get forced out.
Yeah, because they're in theory going to get much stronger over that, right? And if PE has too much debt on some of these companies and they have to end up selling, these guys could be the buyer. So
a good capital allocator is an anti-fragile strategy, I think.
Yeah.
What about the level where they're shopping? The level where they're fishing? $10 million is profit. That's a pretty small company.
Yeah, they are tiny.
I think that's smart. Like, there's probably not a lot of professional private equity hunting at that level. Maybe I'm wrong, I don't know, but that seems low to me.
Yeah, I'm not certain about that. I agree with you, though, on what $2 billion of sales. You're your acquisition target can't be a massive portion of what your business is if you're hunting in that size. Incentives would matter a ton, right? So you would want to make sure the two sons understand that like the father does.
Well, I've been running it since 1990, right?
Yeah.
It was kind of their idea.
Yeah.
I got the sense that there's kind of a Costco element to it as well, where it was like, didn't they do a flat markup of cost basically and then pass that along?
Yeah, they were 15%, so they liked it. So I didn't read closely enough. It was net margin of 15%. And I think Costco targets gross margin of 15%, right?
Something like that, 15 or 17. But yeah, it's a fixed amount.
What are you netting out between gross and net margin? What are they including in that to get to the 15?
Well, you got what
SG&A.
at HEICO? Yeah, you got SG&A, and there's a little bit of R&D. They're not a particularly heavy R&D organization, from what I can tell.
Well, I think they're trying to buy it in, aren't they? That's what they're trying to do. R&D
right.
through acquisition.
Yeah.
But they're not stopping it either. They seem to try to continue on with it once they buy it.
Yeah, it's an interesting, like, part of my hesitation with paying up for some of these growth companies is where will it be in the future? And I do think HEICO's one of those that if you can listen to how they talk about their employees, how everybody's invested in success, the secretaries retiring millionaires, it's not a flashy way to talk. And I almost think it's like a very targeted Berkshire in that if the culture remains, I don't know that you have huge business risk, if that makes sense.
Mm-hmm.
I always get a little bit nervous these days when I hear everybody in the firm's buying stock and everybody's doing really well. I think Enron...
Late cycle.
Enron just destroyed so many people. Like if there's Meb Faber would make this argument where he says, you've already got exposure to that company because you work there, and then to further invest in it, you're doubling up on your exposure. Maybe you should be diversified. Then, if you're inside and you know that it's a really good one, you want to be exposed to it, don't you? That's how you get really wealthy.
Yeah. Yeah, I think so. That said, this is not financial advice, and you should talk to a retirement advisor. But yeah, I mean, I don't, sometimes you really do know something, and having the ability to understand what the culture is from the inside. That said, sometimes I don't even know how much the employees know. I mean, at BMO, I would have misassessed a lot of the stuff that was going on in the organization. So I don't know. What do you actually know?
I've sat in on board meetings and just been kind of astonished at like how little outside directors, how little everybody knows about what's going on. It's just I don't think I know anything these days. I'd love to know what it feels like to know something.
Yeah, well, I think knowing that you don't know anything is probably knowing something. That may be a little circular, but yeah.
Galaxy mind right there.
That's right. Well, there's not false precision in it.
True.
The scuttle blurb thing real quick about TransDigm and HEICO. I like this, what he said. He said, both companies are decomposed into small autonomous business units with their own P&Ls, giving rise to a culture of accountability that is often lost down in top-down bureaucratic structures. That's a pretty – we were talking last week about what might IAC and HEICO and these other companies that you're going to go down, what might that have in common? And that may be part of the clue.
Yeah.
They don't have any scale though on like some costs of, I don't know, even like accounting and back end and things like that, or are they fully decentralized?
I don't know enough to answer that. I'm sure there's some synergies that go on, right? I mean, with your accounting system or something like that.
Kind of hope so, right?
Berkshire doesn't do any of that though, do they? They just...
No,
that's why they have a 50,000 page tax return. That's probably...
All right. Next topic. What do we got?
Jake, you want to go?
Sure. I thought it would be maybe fun or instructive for us to try to add a little bit of nuance around this stretch rubber band idea between value and growth. And, all the value investors have seen this all these charts that come around about how much growth has outperformed value. And I thought it'd be interesting to see if we might be able to back into what are the implicit bets that we're making, and are we really even cognizant of them if we are more of a quantitatively driven sort of like, we're going to buy the cheapest basket of value right now. And, maybe it doesn't apply if you're a Munger 3-stock portfolio guy. But if you're a more, 50 plus and you're just trying to approximate values outcomes historically with your current portfolio, what's the implicit bets that you're making? So more specifically, I thought it'd be interesting to decompose really what are the factors that you're trying to figure out here, and specifically the multiple that people are willing to pay for Glamour versus value, and the underlying fundamental business changes that may happen in between those two companies. What do you guys have any initial thoughts at this point before I try to drill even deeper into that?
I would just say that I think that OSAM have done a few good pieces, and the latest letter also deals with this, where basically value is doing what it has always done. And to the extent that it's not been rewarded, its multiple expansion has not occurred. There's been the reverse. There's been some contraction in it, where traditionally what happens with the growth companies is that they do see that very high growth in the earnings, but they see a little bit of multiple contraction. They've seen the expansion. So it's just been that is unusual. Maybe that is the brave new world, I don't know, but it's still unusual. We don't have enough data to sort of say that the world, I think, has flipped, but maybe you got to start thinking that that's a possibility. I don't, but got to start thinking it for the look.
Yeah. Bill, what do you think?
Jake, what are you asking specifically? Are you saying like the underlying business risk? What would be some of the commonalities that we're betting on? Or
No,
are you just saying like from a factor perspective?
Kind of more of a factor. Like, so if you're buying value today, are you buying it because you believe that multiples will expand in value? Or do you believe that growth multiples will contract? Do you think that the business, for whatever reason, of Glamour will maybe slow down a little bit? Because it has been a really good year, or a good decade for growth companies. Their underlying businesses have done better than historically. Or is it a matter of, is it possible that the multiples will come down for both Glamour and value from here? These are, I think, actually pretty important things to untangle if you are going to be making a value basket type of bet.
Yeah. So I just off my gut, I would say that value is more likely to continue to perform like it has, but Glamour is likely to potentially hit a hiccup. I don't know if I hedged my words carefully enough, but specifically, with SaaS, I was talking. I went out with Scuttleblurb this weekend, and we were talking about how in technology, the nature of technology is that there's a winner, and then a bunch of other companies sort of build their ecosystem around the winner. And right now, a lot of the SaaS names are priced as if they're all going to be the winner that everyone else comes around. And by definition, there can only be a few of those. So that's why I always say, if you really know what you're doing in that space, it's probably a good space to play in. But I think people are just going to get, I think a lot of people are going to end up they're going to own something that they didn't think they were buying. So I have a feeling that there are pockets that people are going to get really crushed in. And I would think, generally speaking, value doesn't have the same stretch to it that sort of gives people that
not the same stretch, but I do think that it is like it's upsetting to say it, but value is probably 50% rich to its long run mean, or maybe not quite 50%. It might be 30% now. It's something like that. Growth is multiples of where it should be, so growth can come back a lot. So, but it could easily be. It's not going to be a scenario like 2000 where the market collapses the .coms are down 80 or 90 or 95% and value is up. I don't think that's going to happen. I don't think it's a 2007, 2009 type scenario either where value gets absolutely taken to the woodshed. I think it's somewhere in the middle where value is probably going to do a little bit better than the market, but it's still going to get hurt. Growth
is that a positive or negative expected outcome bet at today?
Yes,
on the value basket?
Probably still. It's hard. So
pick the time frame too. Probably.
I still think that there's positive. I think the only place you can get positive absolute returns at the moment is in value. Even though I think in the interim, with volatility in a crash, who knows what's going to happen? It'll probably go down. But I think that everything else is priced for perfection and must sort of come back to a long run mean. Whereas I think value probably won't do that as much. But I still think, realistically in a crash, it's going to go down. It's not going to go down as much as the market. I think the SaaS names and a lot of those things are going to get absolutely cut to smithereens.
How about fundamental wise? Any reason to think that the kind of winner take all phenomenon that we've seen, or at least it seemed to have been the last 10 years, that maybe that will, whether it's antitrust comes up more or whether it's competition comes, is there any reason to think that fundamentally speaking that a basket of the cheapest 10% might have better business results? Maybe like a lot of weak hands get forced out, and maybe the more expensive stuff will have a reversion to the mean in business results as well.
Yeah, that's a good question. I don't know. I think there's so many influences that it's impossible to see what the impact is going to be. Are the more expensive names taking business away from the cheaper names, or are they taking funding away from the cheaper names? I don't know.
Yeah, I don't have a good sense either. I would say that in a lot of the stuff that I have seen the deep value pitch on, my biggest concern is agency costs, and I brought this up last week. But I do think that, and Super Mugatu Dan had a good point on Toby's recent podcast with him, where he said he thought the agency costs were more aligned in some of these compounder type names relative to the deep value sort of like liquidation slice, at least, which I thought was interesting. I happen to agree with it, which is probably why I liked it.
So
nice
what does that mean
bias.
in practical terms? What does that mean? Does it mean that they are paid to sort of keep on growing?
Well, if you're long GameStop right now, I'm pretty sure that CEO, part of his compensation is operating income growth. In my opinion, his entire compensation should be total shareholder return over the next 3 years, because a lot of that is a cigar butt that you're hoping to get the money back from. I don't actually want him reinvesting. If I'm buying today, I don't want him to try to grow operating income, especially not on an absolute basis. I mean, maybe if you want to go per share or per store or something like that, fine. But I don't want this guy trying to think about how to grow the company. But that's me, right? But I don't think a lot of deep value guys are like, oh, how are we going to turn GameStop into a compounder, right? So get the guy's incentives aligned with sort of your incentives.
Right, with the corporate strategy that you would like to see.
That's right, yeah.
Well, I think it's a tough question because there are so many variables, whether it's technology, government interaction, investor sentiment. But I do think maybe a lot of times we don't think enough about, if we're going to win, why is it that we're going to be winning? Is it fundamental based? Is it multiple based? And I think a lot of times maybe we don't always strategize enough about those kind of things.
I just wonder if the counterpart to that is sometimes it's, Buffett clearly is smart enough to figure out macro, right? Well, if anybody is, he is. And he says, I don't do it because it's too... And maybe he just says that and he actually does do it. I've got no idea. But it seems to me that it's so hard that you've got to get the sequence of things right, and any single thing in a sequence that you get wrong invalidates the whole thesis.
I would push back a little bit on that in just looking at his actions.
You think that he's more macro?
Well, I mean, borrowing $1 billion in euro denominated specifically, that's kind of a macro bet to me. holding 130 billion of cash is a bit of a macro bet to me. He's like gotten rid of all interest rate risk. Like he has no long duration interest rate risk really. Like that's kind of a macro bet. I mean, his actions telegraph a little bit of some macro thinking, I think.
But aren't some of those ad hoc decisions that you can make on a case-by-case basis that you don't necessarily have to make a prediction? You just sort of look at where you are in the cycle.
Well, I mean, aren't you making a prediction though that what you're doing is going to work out better than if you didn't do that? Isn't that implicitly baked into the decision? But
then you've got this, I guess they're micro decisions though. They're not sort of like some grand macro thesis. Each one is its own, even if it does reveal, so he's interviewed.
I agree with that.
He was interviewed sometime this year. I saw this in a recent article where he said he thinks, it was earlier 2019. He said he thinks if you look at where interest rates are, stocks look really cheap. And then he was given credit for like the big run up in equities last year, which as we've discussed
he's been
before,
saying that forever. Yeah.
He always says that. He said that at the top in 2007.
Yeah.
But he's also implicitly relying on the equity risk premium to say that, which, as we know, it doesn't work.
The Fed model.
But how could it be otherwise? Like that's the bizarre thing about that particular model. But I like the logic of it. Logically, it must be the case because your alternatives are stick it into cash or stick it into like some bonds or something like that, or stick it into an operating business. And if you're getting a better return sticking it in the operating business, isn't that how you make the decision? So how does that thing not work? It just doesn't. Absolute return, the absolute yield on the equities is the better determinant of future returns than the return relative to the interest rates.
It is surprising that it doesn't contain more signal in that noise, but I don't know. Maybe it's probably that it's such a confluence of factors that it just gets kind of washed out by so many other things. Whereas for whatever reason, valuation becomes a stronger signal.
Well, that's my thought, is that you have the Fed there as well, setting the interest rates. So they're sort of putting their finger on the scale a little bit, influencing so when you're looking at the relative attractiveness of one or the other, you've got to add in the fact that the interest rates aren't static and they're going all over the place too.
Tinfoil hat alert. We gotta.
That's their job. There's nothing conspiracy theorist about that.
I think Buffett does do a lot more macro thinking that he leads on. I just also think that his brain does like automatic decision trees, and I think that when you get into macro, there's just so many permutations that he's sort of like, I don't think anyone can be involved in finance and not at least find macro like mental porn a little bit. I mean, it's fun to think about.
And macro guys sound smarter too.
Oh man,
yeah,
so
and it's super fun to put it together, and it's like, oh, this is going to happen, and it's in the world, and it's going to impact you. It's a lot.
Let's talk about euro-dollar bond volatility.
That's right, yeah, okay. And I just think Buffett's probably like, I could have that conversation with you, but I don't think it's worth the time of doing it.
I think it probably is a matter of an inversion where he says, well, would I loan someone else these, billion euros today at right. like a 0.25%? No. All right, well, maybe I'm going to borrow them then instead, because that might make sense.
Well, there's also not much downside. I mean, if rates continue to go down, you just refi them at -5.
Yeah.
And then issue all the debt.
Why is macro so hard? Because interest rates can go negative, it turns out. There's no hard deck there.
That's right, because all of our assumptions actually may not be correct. But
we want to treat it like it's a physics problem. And that there's like some kind of, we can, like you drop the ball and it's going to fall towards some center of mass, but it turns out it's probably not like physics at all. And anyone who comes at it from a first principles kind of physics standpoint is going to probably lead themselves into a blind alley.
So how do you approach it? What's a better model than a physics model?
I think that trying to figure out a specific industry and the strategies that the players are taking within the industry and getting some insight into that. Like the people that made a lot of money, not the only people, but people that did make a lot, were people that followed Schwab understood that Schwab makes less from trading fees than TD Ameritrade and Fidelity did. They cut all their fees. The stock sold off hard. And the people that were ready and there with the analysis that said, like, no, this is long-term good for them because it's going to cripple their competitors, were able to buy in a period when spooked people were selling the stock that didn't really understand. So that's how I think that's how I think you can make money. Other than that, I really don't know, unless you are doing some sort of factor analysis and you're betting on the factor working. That makes sense to me, but I don't know any other way. I mean, I would have gotten every major macro call wrong over the last probably 5 years at minimum. So what good is my thinking on it? Almost none.
You need to Costanza yourself.
Yeah. I mean,
Costanza
I just
macro.
don't know.
Contra bill.
Yeah, well, I don't think I'm a moron or anything like that. I just, I don't understand how the Fed works. I did not foresee Trump getting elected, which would lead to deregulation. There's a lot of things I didn't see.
It's not that you're a moron. It's that.
Well,
it's not that you're a moron. I'm sorry, I stopped there. It's
the
not that.
insults are gonna fly into me.
The point is that everybody basically thinks, the same way. Like, everybody can do the analysis to get to that point, and then it's like going to the parade and everybody's standing up on their toes. Like, nobody's better off for everybody having done that analysis. You have to do the analysis where you work out the consequence of everybody else doing that analysis.
But then what if they're also working that out and then they pick a different analysis to...
Well, now you're John Maynard Keynes' beauty
contest.
So then you're back to first principles, and you're only swinging at something that makes sense on a first principles basis.
It's so recursive. I don't know how you get out of that.
Well, that's why deep value hasn't worked for 10 years.
They've talked about before, like, tell me that 10 years ago you could have said, we're going to be running these deficits, interest rates are going to be here,
and no one cares.
In the cycle, and the dollar is strong.
Zero people picked that. Zero people picked that. Nobody expected that.
No.
So, I don't know. What good is... I can't do that game.
It does seem like one of those things, though, where if you could figure it out, the rest of the game gets very easy. Like, you just know where all the tailwinds are.
But guys figure that stuff out all the time, and they're wrong.
Well, they didn't figure it out.
But they think that they did. See, that's the great danger. You basically, that you're a conspiracy theorist, and you figure out this is the consequence of all of these things happening. Long gold, and then gold gets crushed or whatever. Like that. That's the devilment of it. That's what makes it so hard.
Well, the problem is the system isn't static, right? So you may have figured it out for a day, but everything changes tomorrow. I mean, maybe not that quick, right? But you can't. It's like anything. I mean, everything. I don't know.
So it takes you back to micro.
It is the ultimate kind of narrative fallacy thing, though, where when you look back at it and hear the explanation, it seems so obvious that you could have predicted it. Thinking.
You just slowed down a little bit there, Jake.
You did. You entered the matrix.
Yeah, I think they didn't want me to tell you what I was about to say. Oh no, I just said it suffers from the narrative fallacy where it seems very obvious in hindsight when you hear the story put together of what happened that it sucks you into thinking that you'll be able to figure it out the next
future.
time.
Yeah.
Just not the case.
It's an interesting topic. Good questions. Good thoughts.
Yeah. Toby, what's
I was Heiko.
Oh, sorry, Bill.
I know it felt like Bill was Heiko, but I was Heiko.
No, so I was talking with somebody that listens to the podcast, and he was commenting on how weak my answer sounded to the "why don't I run outside capital" question, and I felt like I probably owe it to the listening base. Hello, all. I think we're up to 10, so hello to all 10 of you. But to be honest about it, right? And I thought about my answer, and I thought it was actually a pretty weak answer. And I guess that part of the issue is I'm still not 100% sure of the strategy that I want to take to the world. Like, I'm really struggling with sort of where I came from in the beginning, which was the Buffett and Graham thing and the way that they look at the world, to these why not buy better businesses at reasonable prices. And the current what?
Reasonable.
Yeah, well, look, I mean, this is an art, right? I mean, I don't know how you define that, but it's like any other asset, I guess. And then the behavioral problem that I have made myself more likely to encounter with the strategy that I'm running, looking for mispricings, is I actually think that, like, who I am gets a little bit of FOMO if I'm doing work on a company that I think could be a good value. I get worried that the market's going to realize it so quickly, and I think it almost
by a half point.
Yeah, well, I mean, I think I need to work on sort of thinking that way. Like, who cares if it goes up a half point, right?
But by a half point. So what I'm saying is, like,
Yeah.
just like sit down and work out a structure. So having done this much work, I'm allowed to buy this much work, I'm allowed to buy this much, and so on. So, like, when you first see it, see all the ratios, looks really good, read a few 10Ks and Qs and whatever, that allows you to buy whatever, half one. And then as you keep on going in, you're like, actually, there's more to this than I realized. I'm allowed to take this position up until you get, whatever your inception limit is, 3, 4, 5, 10, whatever.
75%.
All of it.
125%.
No, I think that's
style.
a really good answer. So working through some of that stuff before I have all that ironed out. I mean, you got to have that. I think you have to have that system before you take something to market. I don't think those are the type of questions that you take something to market unproven, right? And I think that what you said makes a lot of sense. It's actually what I did with that company that I just wrote up, Ollie's, was I did some work on it, and it has a lot of what I really like in a story. So you have the founder that died. You have
that's what I always look forward to.
Yeah, well, that's
dead founder.
To be fair, I worded that improperly. They missed on a quarter, sold off hard. The founder died. I think there's a lot of reasons that weak hands would be selling the stock right now. As I sort of had it written out on a piece of paper, right? And then as I started to pen the longer article, and I started to actually write, what do you have to believe for this to make sense, and what's the actual upside downside, I got to the point where I said, somewhere in the article, I said something like, you need to have a 43% chance of having the current management be able to run the business. And that's like sort of silly, but that's how the numbers that I was working with worked. And I asked myself, like, what makes me the person that's able to make that bet? And I don't have a good answer to that other than time. So I don't know. It's just one of those things that...
That's funny. You could go through an analysis, any analysis, and you could, holding all the other inputs the same, and you could figure out what probability each of the inputs that you have has to be to get... I can see I can understand how you've got to that point. Like, I can see what does this whole thing turn on if I keep all of these other ones static for this one to succeed, this thing working. I think if you did that, like, that might almost paralyze you.
I know, it's kind of terrifying to do, but I do think that, like, for that particular entity, in my mind, the bet is, was this thing dependent on one guy? Can the current management execute the plan? And then I guess the second question is, can they get to their store count? But thus far, they've been able to execute their entire plan. So I'm not sure that the store count question really matters yet. I don't know that matters for another 6 years or so if they have proven it out. Now, there's a short thesis going around that might allege that they're doing fraudulent things with the inventory. That's sort of a whole nother basket of worms, right? But for these purposes, assume it's not a fraud. Maybe that's
since new management came in.
But they've only held one call and they haven't executed at all.
Okay. I mean, this is a perfect opportunity for them to clear that out. Blame it on the dead guy.
Yeah.
That's right.
Big bath accounting time.
That's what I'd do.
He was a charismatic founder. Everybody loved him. So we'll see. I don't know. It's an interesting setup, but it was one of those that I felt like I took a small position because I felt like I had done the work that I needed to do. But then actually sitting down and writing, I was like, I don't know, maybe this is an error of commission here, and one that's an error that
there are no
not
errors of commission anymore.
No,
the only error is not buying. Yeah.
Let me ask you this, Bill. If let's say that 100% or 100 is your perfect, like that you have the best process that you are capable of doing in the investing world of analyzing and controlling for biases, all those kinds of things. What number do you think you need? What threshold do you need to get over to feel comfortable managing other people's money, right? Because you're theoretically always going to be learning and getting better, right? And hopefully your process is getting better as well. But what's kind of that minimum number in your head that you would need to get over to take outside money?
I don't know that I have a good answer for that. I would need to definitely have I need to have an answer as to what kind of companies am I going to target. That I think is something that people probably want to know. Mm-hmm. And two, I would need to make sure that I had a process where I wasn't making early errors of commission, because I think those are probably my biggest personal risk. So if I could have a system in place that sort of, maybe it's a Guy Spear type system where I say the day that I decide to buy, I'm not buying for a week, right? Like, because who cares?
The countdown starts, yeah.
That's right. And just sort of a blockade. That may be sufficient. But
what you need to cure yourself of that little FOMO bug is just to watch prices go down every day in a grinding bear market where you buy and you're like, oh my God, I can't believe I bought already. And it just keeps grinding on you. That might cure you.
Yeah. Well, I do think that this is late cycle FOMO, and it goes back to when I said earlier to you guys how many people have really managed through pain. Extended pain is going to be a much different feeling for a lot of managers.
Well, I've been a deep value investor for a decade. I could write a thesis on it at this point.
On pain.
Well, you have. On just the pain. I was going to say you've written a fair amount of books on deep value.
I buy something undervalued, it goes down further. It's still undervalued, and I got to sell it out because there's other more cheaper stuff around.
Yeah, well, for a while, everything I bought would go down a fair amount
in a rising market.
Yeah. And that's why people ask, like, what's it like to be down 20 or 30% on a stock? And I
never had one go that well.
Oh, that's Monday.
Yeah, that's the first 2 weeks of ownership.
Yeah, well, that's what happened to me on Ryanair. I mean, I bought Ryanair, and that thing was just nobody wanted it, and then I just kept buying more, which worked out. But that one, I think I was right for the right reasons.
Do you have a mailbag question, Bill?
I've got two mailbags. One, I think this person could use our advice, and the answer can just be no, but I'm going to ask for him. It's at Investing Chef. Thinks Apple's stretched, wants to short it, and doesn't know how. Is there a simple strategy to short Apple into this strength?
Buy a put. Buy a little put. That's the only thing you can do there.
You're probably still paying a bunch in vol, though.
Yeah, but you know how much you're going to lose.
Theta, rather. Yeah. I don't know.
This is not financial advice.
That's right.
If you have to express the view, make sure that you know how much you're going to lose, which is what buying a put achieves. Buy it so you got a year or so to run on it, so it's not a short-term thing. I don't know how much your portfolio, but I'd be not half a point or a point in something like that. And just know that you're probably going to be wrong, because that's the market tends to go up.
I think for me, every single one of those, anytime you want to try to win when something's going down, it requires a timing element to be right. And that I believe is incredibly difficult. So difficult. I think you can know probably when something is overvalued, and you can know even like fraudulent things. You just don't know how long it's going to last. And to win, then you have to get the timing right as well. So I personally, if you like Apple but you don't like Apple's price, I would rather hold cash, which I look at as a call option on it that has no expiration, and buy it when you like it again, and instead of trying to win going down as well, but have to get the timing right.
Yeah, and I would say if you're going to play this game, which I don't think is a very smart game, wait until momentum turns over on it, because I just think you're bound to get destroyed buying puts or even selling call spreads. I just don't.
Don't you think that the cost of the insurance though moves up also once kind of the cat's out of the bag and the momentum, right? And everybody's like, all right, well, it's going the other way now, and I'm going to charge to allow you to take
Definitely.
the other side of that.
Yeah, for sure. But I suspect that the benefit from the delta that you pick up is bigger than the cost of the premium that you have to pay. I think shorting strength like that is not a very smart strategy, especially if it's short term.
You got two problems. It's a very good business, and it's got momentum at the moment. Even if the valuation is getting stretched, which, there's probably a few compounder guys around who can tell us how cheap it still is, but it might still be. I'm being flippant there, but I don't know. I haven't done enough work on it. It's very, very hard to short, particularly something like that. I mean, even shorting frauds is hard. Like, they're definitionally trading way, way over what they're worth, and there's no reason why, as David Einhorn says, 2 times overvalued is silly, but 3 times overvalued is no more silly. It's still silly.
Yeah.
10 times overvalued, still silly.
I like what Dan said to you on your podcast, where he said we don't short frauds because by definition they're very good at being frauds, right? Like, if you have a $2 billion market cap and nothing, you're really, really good at being a fraud. I thought that was pretty insightful. Anyway, so that's question 1. Question 2 is from our buddy at Paul H4224. Hope to see you at Berkshire again this year. He said, why do value groupies with long-term mindsets in their life all get attracted to value strategies which inherently are short-term, meaning less than 2-year holds, and contradict a belief that equity ownership creates value over the long term?
I don't fully understand the question. What do you mean by short-term strategies?
So I think what he's saying is if you are playing a game where you're buying something cheap expecting the multiple to re-rate, that's not the same game as owning equity for the long term. And those two are disconnected theoretically. I think that's his question.
I think he's right. Yeah, I think that's true. I think there are different ways to express value, and whether it's different time horizons, different setups as far as business quality versus just pure asset amount and what you're willing to pay for at different thresholds. A lot of different ways for it to make sense. I think you just have to make sure that you understand which of those that you're doing, which one appeals to you more. I think there are seasons for different ones. I think we're in the middle of a more growthy compounder one the last 10 years. I wouldn't be surprised if maybe the price to book as a signal maybe starts to work again.
Oh my goodness. How'd you do that? You just said that out loud.
I think it was the best before. Like, I saw before Cliff Asness shuffled off the mortal Twitter coil, he pointed out that price to book had been the best performed value metric for like 9 months of last year.
Huh.
Well, that makes sense. Like, everything moves in cycles. Like, I've been reading Merger Masters, which was Gabelli and Kate Welling's book about all these different guys that did merger arb, mostly through the 80s when it was a hot period. And the smart ones realized that it got crowded, that the spreads were tightened up, and you just couldn't make money in it anymore. And they started doing other things. And I think the flavors of value go through similar seasons, and just knowing when it's your season and having the conviction to go do it again when everyone else is kind of saying that doesn't work anymore. I I think that's a perfectly valid strategy if it makes sense to you.
Yeah, this is not really answering the question, but I want to keep on going with what Jake said.
I didn't answer the question. I get it.
Jake at Economic, shout out to Jake. I know he listens to it. How are you, brother? He pointed out that in 2007, 8, 9, somewhere around that period, the growth strategies got cheap relative to value strategies. So value, for like a very brief period, there was actually more expensive than growth, which makes no sense. And as Farnam Jake and I have talked about in the past, there's a possibility that we're like momentum value guys because we sort of got on the value bandwagon after value had been working really well, which is the wrong time to do it. That means that I think that at some stage it'll make sense to become a growth investor. I don't think that now is the time to be a growth investor. I think you want to be a value guy. When I say growth, I'm using, that's my shorthand for saying buying better companies, growing at a higher rate, still paying a sensible price for them. I don't think that's now, but I do think that this value cycle is going to play out more. It's going to be a better decade for value, I think, than it is going to be a decade for growth. Maybe in about a decade, you want to be moving up you want to be buying those compounders at lower prices.
I'm probably going to get hate mail for this, but I'm going to say it anyway. I sometimes wonder about the willingness to pay kind of whatever multiple for a great business today. If it doesn't kind of remind me of the .com time frame where you could really make the argument that a lot of those companies they had a better business model. They had a better mousetrap. They were going to have lower costs because they didn't have as much brick and mortar. Like there were a lot of really logical things that you could be saying why you should pay up for this. Like the world kind of had changed. It was just going to take longer. And I can't help but wonder if sometimes now the multiples being paid, we're not kind of replaying that same thing where, yeah, you're right and you're smart. However, the price that you're paying basically erodes all of that intelligence that you have on this decision.
Well, I know who's getting the insults this week. Compound Town, send them to Jake.
I'll take them. I mean, you guys are it's
going to take him down to Compound Town and compound.
Toby and I are long Heiko, everyone. No, I'm kidding.
Do you agree with that or not? I mean, do you guys think I'm an idiot and I'm way off base?
No, I think you're totally right. I mean, that's the whole question. It's the whole fucking horse thing that Charlie Munger always says, right? Like, yes, it's the best horse. The question's the odds offered. And, you can't look at a 2 or 3, probably a 5-year period's enough. I don't know. But you can't look at a short-term horizon and say this is the answer. I do think that where I have erred, so why have I prayed at that altar? One is my own version of hyperbolic discounting, which is being so worried that the multiple is going to re-rate hard on me right away.
Up or down?
Down is why I have historically avoided the sexier companies. 2 has been a real concern about not being able to predict the future. I'm starting to think that is a valid concern, but also maybe I am underweighting my ability to observe the present a little bit.
What a tension that is too, when you really think about it, to try to untangle.
Yeah, I mean it's tough. Like if I just put this in a real estate context, I don't want to be a slumlord buying slums cheap. That's not really the game I want to play. I also don't really want to own Class A real estate where pension funds and all these endowments are going to pay whatever just to own that building. So I think probably where my sweet spot is the financial equivalent of Class B real estate that has some sort of scuttle blurb. I'm throwing out his name a ton, but like he said it to me in a way that made a lot of sense. We were talking about small caps versus large caps. And he said, I think that's the wrong mentality because there's sharks all over small cap world. He's like, I like to think about it as the proportion of dumb money to float. And that I thought was really, really smart because that's where I think I want to play, where there are scenarios where retail or some hot money gets scared, but the business is pretty good and I can sort of provide the liquidity at that time. That would be where I think I'm going with this. But historically, it's been a fear of multiple re-rating and a lack of confidence in predicting the future.
So he's saying that the larger cap space is actually more inefficient than smaller cap space, effectively?
Yeah, I don't know that he would say large cap necessarily, but
what, mid cap?
So an example of something that I think he would be comfortable with me quoting is he said, like, there's a lot of people that are in trade desk today that don't understand what they really own, right? And that could be a scenario where you get a short-term move when people are paying so much for the equity. Something that really doesn't impact the business could cause a huge sell-off, I think is sort of what he's thinking. So, but I like that way of thinking of things. So
that is an interesting multiple or ratio, I should say.
Yeah, because you look at some.
Do they publish that on like Morningstar or something like that?
Yeah, they should.
Dumb money.
Small cap names like I'm sorry, Matt Clarkin, that guy that writes Clark Street Value. That guy's one of the smartest investors I've ever met. I mean, every time I talk to him, I think he's the smartest guy in the room. I don't want to play a game against him. And he messes around in short, small cap, special situation stuff. There's a lot of sharp money in that space. And I think a lot of people do a mental shortcut where they say it's small, therefore there's a lot of dumb money. I don't think that that's true at all. So,
it's an interesting question.
I think we're coming up on time, fellas. If folks are looking to get in contact with you, how do they do that?
Jake?
I'm on the
email this week.
Yeah, send all your hate mail to just.
I'm probably
just
due. Send it to me.
Tag your hate tweets. You can tag me, and I'll cry and pretend that it doesn't bother me. And
he's at Farnam Jake 1 on the Twitter machine. I'm at Bill Brewster SCG.
And I am Greenbacked, GREENBACKD. Thanks very much for listening, folks. It's a lot of fun, as always. We'll catch you next week.
See you next week.
Take care, folks.
Move with the rhythm. Shake it up, stop when the clock hits 13. Sing 1, 2, 3, 4. Cause